on whether you're in an emerging market economy and whether your country is a net commodity exporter or not, and particularly in the oil space. And that is also driving sentiment. One of the things that is really affecting and dislocating the connection between inflation, interest rates, and what's going on in the markets is that traditionally, when you see interest rates going up, it's in response to growth, which is fueled by consumption. The man in the street is going out to buy more. At this point in time, the inflation is not driven by growth. It's driven by dislocation in supply chains, and it's driven by a higher oil price. And so there's a dislocation in the increase in inflation, and this is not relatable directly in classical terms to the price of equities. Notwithstanding, there is still a strong response away from growth stocks and towards value stocks.
You opened a lot of cans of worms there, so we'll get to them. Inflation. But Nick, I do want to bring you in because Oliver Wyman just published a very extensive, wonky, I would say, report on whether the markets are disconnected from reality, and there's very complicated models in there, like an HMM, is that right?
Holistic market model, yeah. Wonky
whatever that means. Are they disconnected?
Wonky in terms of the American definition rather than the English definition, which means all out of kilter. Yes, as the management consultant on the panel, I'm going to defer on short-term market issues to my fellow panelists, although Kate, I don't know if you noticed this, I was delighted to see that you actually moved the market. Private equity rose.
I did. I saw that.
I said we were going to move markets.
Oh, you said it. Yeah, I mean, I think the first thing, one of my colleagues in the Oliver Wyman Forum has spent a long time, multiple years, looking at 150 years worth of equity market data, particularly on the US equity markets, and basically concluded that a lot of the metrics that we traditionally use, even some of the sort of Schiller PE type metrics, which are sort of through the cycle, were just not based on good long-term data. Because the earnings data has been based on different accounting principles over time, because personal and corporate tax rates have changed over time, etc. The quite strong conclusion was that while the equity markets certainly had some fluffiness in them, before the bear, well, if we're going to call it a bear correction, happened, they were not actually as overvalued as some of the more traditional metrics might have supposed. And we can talk about some of the more wonkish aspects of that later on. I mean, there have been things like a 40-year rise in corporate profitability to the point where pre-tax margins are actually at an 80-year high, post-tax at a 100-year high. And some of those things may be challenged by what's happening now, but actually give some support to the market. I would say out of that list, the one that may be underrepresented is commodity markets. I think because of some of the, later maybe linked to some of the things you were talking about, because of some of the dislocations, supply chain issues and so on, you've seen some very high price moves in things like battery components like lithium, which I don't think are necessarily long-term sustainable. I mean, I do think some of that may settle out. It's a bit reminiscent to me of some of it of what happened with silicon in whenever it was, 2007, 2008, where the price of silicon shot up, and everyone said, well, solar panels are no longer going to be economic. And then actually, it was fine. So I think there are some dislocations in each of those markets.
It's funny, I'm not an expert on this panel, but if I voted, I would have said fixed income, which 0% of people said, because, Katie, if we're going into recession, then you would think bond prices would go up and yields would come down. And we've seen quite the opposite happen.
Mm-hmm. Yeah, that has been very unfortunate for investors because they count in a 60-40 portfolio, which most assets around the world are invested in some version of that. They're hoping to have negative correlation between those assets, and we haven't had that for most this year, but actually recently that started to express itself a little bit more. I would just say, I think we need to consider the possibility that from a rate perspective, we obviously have an inflationary environment. Rates can't fix all of that, like they can produce oil, for example, but I do think there's going to be a bias towards raising rates. And I agree with Bill Dudley, who obviously knows much more about this than I do.
Tank the stock market?
Yeah, former Fed governor, right, who said this quite publicly, that there's probably more of a bias towards putting downward pressure on equity markets to tighten financial conditions, because raising rates alone may not be enough to rein in that inflation, and there's a possibility that we may need to, the strong dollar helps, but it's probably not sufficient. We may need to do other types of tightening financial conditions.
Yeah.
Sorry.
Just on the correlation point, I do think that that negative correlation, certainly one of the bits of analysis coming out of this 150-year view, was how the relative correlations between treasuries and equities has changed over time, partly driven by the inflation environment, but actually one of my colleagues, Jacques César, who's led this work, one of his hypotheses is some of that has just been learnt behaviour. It is an expectation that some of that is going to be an inverse correlation, and that actually that could break down again. The way that relationship worked before the Second World War was radically different to the way it's been working now.
Well, we've had zero rates. We've had tons of stimulus. That certainly helps. I feel like we should just get it out of, so how many here think that we're going into a global recession on this panel? No? Nobody? A US recession? Anybody?
I think it all depends. So just to the points the points that you were raising on the bond market and the equity market. This is the first time that we've seen a downturn in the bond and the equity market, and the reason for that is that inflation rates are rising, as I said earlier, and you're not seeing the cause of that as underlying growth. It's dislocation in supply chains, and it's high oil prices. None of that is translating into value creation in the broader economy. And so what would determine a stagflation or a low growth and therefore recessionary environment is particularly the big economies turning down. So right now the US is a net exporter of oil because of their shale growth, and so that could counterbalance those bears who are into the inflation environment. Europe seems to be far worse hit because of their reliance on gas. So I would say that the impact on China and the response of China in the current macroeconomic context and the length of the geopolitical dislocation, which would have oil prices higher for longer, are critical determinants around whether we're going to be in a global recession or not.
Well, and also they're going opposite directions on monetary policy. I was going to ask you,
Yes.
Hayla, if it matters more for South African growth and stocks that China is easing or that the US is tightening?
Yes, we're in a really unorthodox environment in the sense that, firstly, from a South African perspective, we're an emerging market, and we've seen interest rates going up to 27% in the late 90s during the Asian crisis. And for the first time, we're seeing South African inflation at a much lower rate than the US. And at the same time, China is decreasing rates. So you've got regionalization and pockets of economic response rates. And I think what will determine the South African position, firstly, we have a high commodity market, and our connectivity to China's consumption and demand for commodities is a big dynamic. Secondly, there is likely to be a surge in green commodities rather than the traditional commodities that we've seen, and we do produce a fair amount of that. Thirdly, the South African economy is shielded from the somewhat less affected on the oil price because and the gas inflation, because we're not a gas-dependent economy.
So Ahmed, what about Europe? Because that's one of your buckets of investment. Recession there?
I think it's a higher likelihood than the US.
Yeah.
I don't think we're there yet. It's very dependent on geopolitical issues, the war in Ukraine. I think how long that drags on will have a continued negative effect. I think the energy shock has happened to the extent
They're going to raise rates with no growth.
So that's a third quarter issue. And I think what happens between now and then is very important, and especially for countries like Germany and finding replacements for that energy supply, and how we see the easing of the gas prices in Europe will be very dependent. We're seeing a bit of that happen. Probably not enough though. I think more needs to happen. And that I think that becomes determinant. But if you look at sort of where I would stand today, look at economic indicators, would I forecast a recession? Probably not.
In Europe?
in Europe. I still think
You guys are all like way too optimistic, huh?
I'll say, I have absolutely no idea if there's going to be a recession immediately or any. I know that eventually there'll be one because the world moves in cycles. I'm not a macroeconomist, so can't predict it. I'd love to say we're going to have a soft landing. That's a warm blanket I'd really like to wrap myself up in as an investor. The reasons I am cautious about that on a global but particularly U.S. scale is what we've already talked about with the Fed, the fact that the companies are telling us that it's getting more challenging for an operating environment. And, you know, having done this for some period of time, we haven't yet engineered a soft landing in my investing career, and I'm not sure why we'd be doing one when we're getting the greatest rate hike in a generation. All that being said, I could be wrong. We're wrong often. But that leads us to be very balanced in portfolios. That may not sound like a brave thing, but I actually think it's the smart thing. I'm not saying being overly diversified by the number of stocks, but having exposure to actually commodities in an equity portfolio alongside growth is a wise thing to do. I do think, I will say with very high conviction, that I think there's an incredibly attractive setup for innovation and technology assets in the public markets if you can take a long-term view. I do believe that this is going to be we'll look back at this as an incredible buying opportunity for some of these highly dislocated assets in public markets.
So the headline is Goldman Sachs Asset Management says time to buy tech stocks.
I know that CNBC wants that headline, but I'm gonna come back with a little bit more nuance, which is if you have a long horizon, and that's a great way to create wealth, is to look a few years out, which most people can do. First of all, I would not be selling, because this is the point when people inflict a lot of damage and wealth destruction, not a wise decision. I would be staying put or rebalancing into this market that's going down. And I would say you can find some assets, again, in the tech space that I believe are overly discounted using real valuations, not some of the valuations that were being used the last couple of years.
So when you say tech, sorry, I'm just going to harp on this one more. When you say
Sure.
tech stocks, do you mean like Netflix or Apple, or do you mean like Zoom Video or Teladoc or Peloton?
There's three parts of the tech market that look very interesting to us here. I would say software. So there's a lot of CEOs at this conference. I would ask them, when you run into them, are you planning on cutting your enterprise spend? Very few of them are going to say yes. So I guess the argument we're making is that it has a secular tailwind. Mm-hmm. The spending will happen through the recession. Software, famous quote, Robert Smith, CEO of Vista, says software is better than first lien debt, because this software has become very essential to running businesses. And CEOs are unlikely to make that their first cut. Layla would know that as a CEO of a major company in South Africa. You're probably not cutting your enterprise spend that to run JSE. Then the second area that we think is interesting would be semis, which obviously are fueling all of the innovation that we're having. And then finally, cyber, which has a tailwind from the geopolitical disruption. So if you're battling inflation, you're going to invest in software as a way to control costs. You're going to try and extend your competitive advantage, which means that you're going to move more data to the cloud and use AI and machine learning to organize that better. And you're going to try and secure that data through cyber. So those are all areas that look interesting to us. 40 to 60% down in some cases, both on price as well as valuation. And that is the reason I think it's an interesting setup, again, for the long term.
Layla, what were you going to say?
Yeah, so one of the key drivers, which we haven't touched on, we spoke about equity and bond markets being in a pretty bearish space, is the front loading of the Fed interest rate curve hikes. And we're seeing a very unusual and complex pattern emerging, which means that the Fed are by increasing by 50 basis points, the market is pricing another 50 basis point hike in. There's a front loading of that. And what's happened is the yield curve is inverted. And what I mean by that is that 2-year bonds are now offering a much higher yield than 10-year bonds, which is completely unexpected. And as a result of that, money is more expensive. And unless we see wage growth going up to counterbalance that, we are into a high-risk recessionary environment. And who is that going to hit? It's going to hit the manufacturing, the retail, and all the consumer-focused stocks. If we look at a high interest rate environment, the financial sector, the banks, might earn more interest income, which would be obviously obviously accretive to their earnings. However, they could also be facing higher default rates, so customers not paying their bills. And so depending on how clean their books are, that market could get severely affected. Of course, the commodity market, particularly in South Africa and in the emerging markets, has created a tremendous surge in tax revenues. South Africa, for example, is the only emerging market country that has a lower fiscal deficit this year than they did in 2019. And that's largely because of the massive export and growth that we've seen in the commodity market. So it needs to be looked at on a sector-by-sector basis, but certainly one of the classical principles is that when interest rates are low, tech and growth stocks are really at risk of being overvalued, or there's a high valuation placed on them. When interest rates start to rise, there is a focus on the basic value stocks. And the question is really how is the fact that this interest rate cycle is being fueled, how is the fact that it's being fueled by high prices and the dislocation in supply chains rather than actual growth going to affect valuation of all of these stocks?
Yeah, I mean, I think, Sarah, one of the reasons why you're getting the reaction you're getting, when we talk to clients, we see a lot who are torn between that sense of, do I prepare for a downturn now, or by preparing for a downturn now, do I create my own downturn?
And we should be clear, you do a lot of financial services, right? Those are
We do a lot of
primarily
financial services work, and I mean, the experience there is interesting because the pandemic didn't create quite as many write-downs as people had necessarily thought it might, and so there's perhaps a little bit of a mentality there of some excess reserving. I'm not sure, but on the industrial side, on the retail side, I completely agree with what Leila just said about the different effects on different segments. We had the leader of a major retail financial institution yesterday saying, you can look at certain aspects of spend which look like they're, like the news Kate was describing, like the recession is upon us, but you can also look at other segments with people who have been locked down for 2 years, have saved at higher levels than they've ever saved before, and frankly want to have a good summer. And so seeing really divergent effects. But one of our competitors, I don't like advertising my competitors, but they had a nice line yesterday, which was, we're kind of in the grief phase. People are sort of arguing about whether it's going to happen, but some people are beginning to move into the bargaining phase, which is, okay, we're going to have a recession in some regions, but when? No, it's going to be later. It's going to be next year.
And it's going to be shallow.
Yeah, and it's going to be shallow, exactly. No, I'm more optimistic for the US. I think there's a chance there. I think Europe is on a tougher path.
Ahmed, where are the opportunities for you right now? Because so your baskets are Europe, Turkey, and Russia, which are all kind of problematic.
Simply put. So
You've got the Gold Star portfolio.
I do. I think what we're trying to look at within Europe, so historically it's been our biggest exposure and where our portfolio has been concentrated. Very much we're trying to diversify away, but within Europe, what we're looking at is we're looking for the next shining stars. So it's not the typical names that you probably hear every day. So we're looking at the new emerging, I would say, growth stage tech companies. Some of them are quite small, fly below our radar, but we believe that we're seeing a lot of determination from countries like France, Germany, Italy slowly. I mean, if we look at sort of the VC space, last year, 2 years ago, so 2020, total VC investments in Italy, full country, 500 million. Last year, slightly above $1 billion. This year in the first quarter, they're already at 800 million. So you're seeing huge growth.
Why?
So huge support from the government, I think, number one. Number two, entrepreneurs are finally seeing the opportunity set of staying in country and seeing that they can build their companies within Europe and not flying away to Silicon Valley. Recently, we did an investment in a Turkish company, the first female-led unicorn in Asia. Again, there's rays of hope where valuation is not so sensitive anymore. These companies are smaller in size, and you're able to get a better value than what you would see probably in the public markets. So we're trying to find these opportunities across the region. They're not easy to find, but they're there.
What are you doing in Russia? Buying, selling, holding?
What can I do in Russia?
I don't know.
Nothing. So the reality is
You can exit.
we can't.
You can't.
all foreign investors are restricted from acting on it. So we're
You guys have
basically,
a stake in Rosneft, right?
we do. So that's the only stake that is of significance within the portfolio, but within the grand scheme of things, it's very small. But we can't do much in Russia. We're waiting and seeing. I think.
What do you want to do?
Waiting and seeing right now. I think at this point in time is well, we'll keep it at that. But we have to really assess where to stand on those opportunities there. I think it is a very difficult position for us, being an investor with it's one name, quite frankly, and assessing how we move forward with that will be the big challenge.
Well, there's a geopolitical.
It's a geopolitical,
impact.
but it affects us as much as it affects any other investor.
And what about Turkey? Can you invest in a currency crash?
So we have been investing in Turkey, and we continue to invest in Turkey. And what we are finding is opportunities of two types of companies, I would say. So Insider is a company, Turkish founders, but very much international in what they do. So you can find those opportunities. There are companies within Turkey that are able to mitigate that currency exposure. And those are the companies that we're looking after. So we are a dollar-based investor. It's extremely important for us that we manage our returns in a dollar basis. So we're extremely thoughtful about what we do, especially because of the currency. But we believe in the long-term economy of Turkey. We believe it's going to be a great opportunity. We are seeing some investors starting to re-enter Turkey. And I think giving the ability that we have the ability to be long-term in our investments, we can be patient. But we'll be patient, but we'll be smart to ensure that we're not doing anything that can, in the short term, also turn against us.
Well, we're talking about problematic parts of the world, Katie. What about China? Because, on one hand, there's shutdowns, growth is not good right now, but on the other, pandemic has been very good for markets.
So it's interesting listening to people. I don't know if you guys had I'd be interested in your experience, but people are very negative sentiment on China now. A lot of people calling it, from a capital market perspective, uninvestable. And you know what the last thing we all called uninvestable? Energy. Just think about that. I think China's really facing some very significant challenges. The geopolitical one is going to be protracted and an overhang. I will say that at the moment, the economy's shut. At least a third of it is shut. And when I think about all the challenges, macro challenges facing the world, of which there's a lot. We just talked about the Russia-Ukraine war. We have this inflation issue we're trying to grapple with globally, but very pronounced in the US. And we have the second largest economy effectively closed. It's that third one I actually have the most confidence is going to sort itself out. China will reopen, and there's the possibility that they actually reopen and stimulate the economy. And so how does that make me think about equity markets from here? It is we manage a lot of emerging market assets for our clients, very diverse portfolios, very proud to be a shareholder in Layla's company in South Africa. Stock exchanges, by the way, incredible assets. I can sell that for her. High free cash flow, connected to the deepening of capital markets. We own them in a lot of emerging markets. We actually own it in Hong Kong too. But when you look at China, it's about half of the EM opportunity set. So it is important for people to feel comfortable with that if they're stepping into emerging markets. I believe, and our team believes, bottom up, there are selective opportunities that look attractive from here. And so areas that are of interest to us include companies that are driving climate transition. It's an economy where the government tells you what they're going to do. They're going to tell us again in September, and they generally do it. So that actually helps as an investor. You kind of get behind what they care about and try and avoid the things they may want to crush through regulation. So where are the tailwinds? Climate transition would be one. Digitalization of the economy would be another. So as an example, yes, there's a lot of regulation in the big part of tech in China. We own a small mid-cap company called King D Software that drives digitalization of small, medium enterprises. And it, just like the software businesses I described before, highly free cash flow generative, compounding at a high rate, and at a very attractive valuation versus its history, software generally, And so those are interest. Selectively, I think you can find assets there. And yes, there's a lot of bad news. The market's also trading around a 10 times price to earnings multiple. So hopefully that answers it for you. I think there are going to be an overhang, and it's going to take time to work through that. There's also a near-term reason to believe that things could get better, which is that it is going to reopen. And most critically, you have to be extremely selective and careful about what assets you want to own.
Nick, what do you tell your clients to do in China right now?
Couldn't possibly comment on what we tell our clients to do. It's definitely a tough environment, and for us in our business itself, similarly, it's been very difficult. It's probably the one region in the world over the last 6-8 months where we haven't been growing quite strongly.
Why? Because of COVID or because of regulations? Or?
Mostly because of COVID and ongoing lockdown. I mean, our team in Shanghai is delivering food to their grandparents and our alumni's grandparents. They're not doing consulting work. But I will, one of the things we've done a lot of work on in China, and I will double down on Kate's point about financial infrastructure and sort of fintech in general in China, but globally. You only have to look at the largest financial institutions in the world. 10 years ago, I think 2 of the top 50 were not balance sheet-led organizations. Now it's a third of the top 50. And China may be one example. I would argue the kind of crypto crash is another example. It's amazing to me how short people's memories are when you look at, if you threw away e-commerce in 2001, where would you be now? Out of the wreckage of some of those things, really good businesses and really good assets with really valid uses, which, to Kate's point, if you can look out even only a few years, I think there's excellent stuff to both businesses to grow for our clients, things to invest in for yours.
We're getting really good questions in from people, and please continue to submit them if you like. I'm going to share some with you. And you just mentioned crypto, so we'll start there. What about the crypto markets? Are they going to drive market disconnect going forward? I don't know if any of you are crypto people, are you? Or have a view, at least?
Well, I mean, I think there's a huge amount of extremely valuable infrastructure that underlies it. It's just a shame that the first applications always go towards speculation and dragging in a wider and wider array of the retail market into speculation. I mean, the whole stablecoin, the whole algo stablecoin thing felt a lot like the money market breaking of the buck as a sort of a bit of a challenge to the whole sector. But I think there's enormous opportunity for new models to emerge, which could create substantial dislocation in how finance is done.
I think crypto is too big to ignore. There's a cyclicality to it and a systematic factor. So during a low interest rate environment, people will pile into a crypto type environment. I think that the uneven regulatory approach to crypto is concerning. I've spent a week with my regulators and market participants in Zurich, meeting with crypto and digital asset companies, because I see that as the way of the future, and there is a reluctance by many regulators to step in and to start regulating because they're concerned about legitimizing the environment, but most of those crypto environments are actually bigger than some of the regulated and large exchanges. So crypto, digitized assets, tokenized assets are definitely a burgeoning asset class or commodity or currency, depending on how the country classifies it. And I do think more needs to be done in front running and starting to develop that regulation more preemptively. I also think that there needs to be closer integration between the decentralized and digitized environments and the more centralized formal environments.
Is the Qatar Investment Authority in any crypto companies?
So we look at it slightly different. So we look at the underlying technology, so blockchain. We're looking at maybe some of the exchanges. I think the technology is there to stay. I think the cryptos are still a bit early for institutional investors to go into with any weight. Tokenization, I mean, we've seen Goldman talk to us about tokenization of real estate. So I think these are new ideas that probably are being developed and will stay. And I fully agree, the market is too big to ignore at this point in time.
But also could mean that if we continue to see pain in crypto, Katie, and because it's gotten so big, potentially systemic, that could impact other markets like stocks, right?
Of course.
Yeah, it's interesting, whenever you are in moments like this, things end up being more connected than what you originally thought. Don't you feel like that's But we haven't yet had a big accident. Like I would have thought we would have seen more stress in, I don't know what you guys think, but in the credit markets, which hasn't really come through yet. So I don't know where it will manifest itself, but my guess is that there's got to be some more stress out there to come in the economy. There is clearly going to be, we talked a little bit about private markets before. We could come back to that. I know you had mentioned, Ahmed, that you're starting to see the down rounds come. I don't think that's been priced in the same earnest yet that it has been in public markets. And what's the feedback loop of that? Again, to public markets and the real economy and the job losses. Like maybe that's a place where we haven't yet seen all of the pain. But for sure, if we have this continued downward pressure on broad capital markets, there's something else probably that comes loose. That's probably been our collective. I don't know what you guys think, but.
Anyone?
Yeah, I fully agree. I think if you look over the longer term, the burgeoning of private markets since the GFC particularly is pronounced, and the contraction of public markets correlates with that. I would argue one of the key reasons is because there's so much cheap money from central bank stimulus. During a rate hiking environment, that cycle is likely to adjust, while systemically private markets will remain an asset class. And in fact, the JSE, in line with what NASDAQ and a couple of other exchanges have done, have recently launched a private market platform to enable that new form of capital formation. I do expect that as rates start to rise, you're going to see that opportunity cost and the pricing in those forward PEs and price multiples, eye-watering price multiples that you see in some of the private equity environments contracting. Just to link back to what Ahmed was saying about some of the smaller Chinese companies, while the regulatory, what some would argue is draconian and others would argue is appropriate regulation of the big tech companies, have really dislocated the Barbers, the Baidus, the Tencent. One could argue that this creates investor certainty and really paves the way for investor confidence into those smaller tech companies. And let's not underestimate the number of smaller tech companies with highly innovative solutions that are in a walled country with enormous population take-up. So that could be a new interesting growth node, notwithstanding the very strong risk-off attitude by institutional investors into China right now.
I want to get through some more quick questions here. What should businesses do to prepare for the volatility of markets? That sounds like a very much, Nick, what you get paid to advise people on.
And we get it for free, right?
Yeah.
Well, I mean, so I think it is sensible to hunker down and look at the things which you are doing where frivolity creeps in the better times. You know, I think there is a very fine line for many businesses to take to make sure they're not creating their own recessionary environment just for their own business, for their own company. But with the best will in the world, over time, inefficiency creeps in, little hobbies creep in, people at all levels of corporate management don't like to say no, and stripping back and making sure that businesses are lean and, you know, coiled to react to what's going to happen. It's not a bad time to be doing that.
Say no more. That's
Say
the
no
advice.
More. Yeah.
I think actually I would point to the Uber CEO as having an incredible statement about how to prepare a business to run it through this difficult period of time. You should read it. I won't rehash all of it, but one important thing was the market's changed its focus. So if you're the CEO of a public market company, we don't want to hear any more about TAM and revenue only. The market's focused on free cash flow. So what's your free cash flow story? That's going to help you get investors behind you now and going forward. And are you a management team that has built up some ballast in the balance sheet? Did you raise capital when it was available, not when you needed it? Do you understand how to drive profitability, how to control costs without driving yourself into a recession? I think that's a very important point. But to recognize that the environment's more difficult and the market's looking for something different now. Sorry, go ahead.
I was going to say, I think that's exactly right. The second thing I would add, though, is don't take your people for granted.
Yeah.
It's very easy at these times to say, we just take that for granted. A recession is the time to prepare yourself for the recovery to come. And certainly in our business, the most important thing for us is to say that our people love being a Marshall McLennan or Oliver Wyman, and are going to hunker down with us as the business hunkers down. So you can't view your people as just an expendable cost in all of that hunkering down.
I would add to that just to say the best businesses actually will invest in their people and use this as an opportunity to pick up more talent. Microsoft, you probably saw announce 20% wage increases across the board because they know that engineering talent's going to come out of some of the more stressed parts of the tech market. Microsoft's not stressed for the obvious reasons, and they're going to use that as an opportunity to upgrade talent. So being in that position to act countercyclically can really set up a business to consolidate market share and perform coming out of whatever environment we're going in.
Have these values trickled into the private market yet, into some of these companies you're investing in? Amin?
I don't think so. I don't think so. I think that's why, the biggest challenge has been for us in terms of finding these opportunities is finding the ability to sort of bridge the fact when you look at the peers, you do look at the public peers. And you see that shift coming down, and you see the private market still holding tight. Again, I'd say we're starting to begin to see that weakness. I'm quite interested to see how that has the rollover effect into the public markets again, seeing that the private markets are being a bit more weak. But again, it's also sectorial, right? So software is going to be more resilient than anything else. But I think it's still early for the private markets, and they're sort of in a wait and see. And people can afford to hold their marks as where they are if they're cash rich. But if they're not, that's going to change very quickly.
So we have just under a minute left, so we'll do a final quick and dirty for everybody, which is, so we started with which market is most disconnected with reality, but I think ultimately the reason to discuss this and why people are interested is where's the most opportunity in the market right now, across assets, across companies, across economies. One answer from everybody that will hold you to.
I'll start. So I already talked about technology, long-term, all of my views, disclosure, long-term orientation. I'm going to pick biotech. I talked about valuations. We have to focus on real valuations. When people tell you stuff's cheap relative to 5 years, 2 of those years don't really count. Capital was free, it's no longer, so you have to be very disciplined in looking at valuations. Biotech clearly has risk in it, but if you look at the small mid-cap biotech part of the market, that market capitalization of the entire part of that market is actually less than the cash on the balance sheet of the 12 or 13 largest US pharma companies, which is real takeout value for them. Now, some of those companies are burning cash, so and many of them are, so they may trade less than cash on balance sheet, but there are innovative ones. Some of them are coming up with very important solutions. Many of them will work, and that is a valuation you can believe in if you can commit for the long term.
Nick?
I'm tempted to say, riffing off Kate's previous answer, just finding great people to fuel your business. I think there's huge value and opportunity there.
That doesn't count.
If you want an asset class, I'd say areas of long-term disruption, particularly those backed by the macro policy. So climate change, climate tech, fintech, financial infrastructure.
All the Oliver Wyman clients, of course.
We cover all sectors.
I'm just kidding.
I'd say in the short to medium term, value stocks are important. In the medium to longer term, sustainability stocks are critical, particularly green commodities. If the current dislocation geopolitically persists, oil is likely to remain higher for longer, and those countries that export and are involved in that space, if China bounces back, commodities will continue their long tail.
I say companies investing in the energy transition, and that could be across a multitude of various sectors. And then I think the other one is new entrants into the fintech space. They've been hit badly in the last few weeks. I think there's going to be opportunities coming out within the space.
Very good. Thank you all so much. Great discussion. Thanks everyone for being here. We're out of time.
Thank you.
Have a great day.